Just because we're headed into a Fed-mandated recession, or at least many think that, doesn't mean that all industrials immediately start falling apart. Take ITW, Illinois Tool Works. It's a maker of specialized industrial equipment that I like to think of as a manufacturer's manufacturer. Yesterday morning, this company reported a terrific beat and raise quarter. Just a great set of results, with management raising their full-year organic growth forecast from 7 to 10%. To 11 to 12%. That's extraordinary. That put Illinois Tool Works in an elite company at a time when most industrials are struggling to post positive growth at all. In response, the stock jumped $5 before tacking on another buck and change today. So how the heck did these guys pull it off? Let's check in with Scott Santi. He's the chairman and CEO of Illinois Tool Works to get a better read on the quarter and what comes next. Mr. Santi, welcome back to Mad Money.
Hi, Jim. How are you?
I am good,
to be
thank
back.
you. Oh, it is great to be back, to see you. I've got to tell you, your 80-20 rule is working. Your decision to be in all the markets that you can dominate is working. And I want to get right to it, even though a lot of people are very worried about a slowdown. And I know that you're honest that some places are slow. The amount of business you're doing and the percentage increases are staggering. What is your secret across so many different industries? Food equipment, auto, residential. These are all so strong. How did it come together?
Well, I'd say that we've done some really hard work in terms of keeping ourselves positioned all the way back to the pandemic. We had an opportunity to make a decision at the depth of the pandemic that was to really keep all of our people fully on staff, all of our team members around the world, to stay invested in our businesses, and ultimately position ourselves for the recovery. And I would say that is at least in significant part helping fuel our results right now.
Well, I want to flesh that out because, Scott, most of the companies I deal with, particularly in industrial, they laid people off. They gave people big buyouts. They really thought things would be bad. Those people never came back. And so when things got better, there was a huge scramble. Are you telling me that you had your people in place and were ready to win with this recovery?
That's exactly right. We in the depths of the pandemic, we were a different company by then than we were back in the 08-09 recession, and it had built a business that was much more profitable, operating margins solidly in the mid-20s, and that certainly gave us some options in terms of how we wanted to handle and position ourselves. The decision to stay fully employed was partly a values-based decision. We thought it was the right thing to do, to be there to support our people in one of the most uncertain times personally for all of them. But by the same token, we thought it was a really good business decision for exactly the reasons that you talked about, to stay in position to support our customers on the recovery was the right thing to do for the business and from the standpoint of our competitive positioning all around the world.
Well, I'm glad you mentioned competitive because, for instance, restaurant up 40 is really extraordinary. Did other guys just not able to handle the orders and you took them?
Well, I'd say to some degree from us, the supply chain issues have been certainly significant. We are not immune, but from the standpoint of our, again, decision to stay invested, that included staying invested with our suppliers. We are a company that produces where we sell around the world. We developed localized supply chains around the world. And during the depths of the pandemic, we kept enough business going to our key suppliers because we knew, just like our people, we were going to need them on the recovery. And so to some degree, I would say all of that ultimately is putting us in a position where we can supply where maybe some other people are having more challenges in that regard.
Well, yeah, some people are probably saying that's an extraordinary business decision. But you guys have been around for a long time and operate quite differently. Not that you're willing not to sell a division if you don't think it's right. But take automotive. You're 26% Europe, 3% North America, 29% China. No one had that kind of growth. People really pulled back from automotive, but you didn't. You leaned into it.
Yeah, and I would certainly point out that part of the sort of positive in those comparisons are against third quarter last year. That was probably the height of the chip shortage in terms of constraint on automotive production. That being said, our ability to supply our customers as this chip problem starts to ease and demand remains strong in the automotive business is certainly an element of our gaining share with our major OEM customers.
All right, now I'm worried about residential, as are you. You mentioned residential is possibly getting soft. In the interim, is coming from, for you, a remarkable level, even as others are falling by the wayside. What did you do in residential that made it so it was, that it really just was magnificently even at all times?
Well, I would say through the third quarter, business remained relatively strong. We are certainly not immune, and as we talked about, we have definitely seen some things pull back late in the third quarter. We expect those to continue. That's probably the most interest rate sensitive part of our business, but yet it's only 6-7% of our overall sales. But I would say overall that we have focused really hard on only operating in highly value-added spaces of the residential construction market where we can deliver solutions to our customers, and ultimately that does, our ability to continue to innovate and create new solutions does take some of the cyclicality out of it for us.
And just in the final moment, I want people to understand 80/20. I've mentioned it twice.
Okay.
It is clearly the secret sauce. Others don't have it. Explain to people how it works for you.
Well, at a high level, so 80/20 is really the core competitive advantage of ITW. It's a methodology that we have built up in the company over the course of the last 30 years or so, and it's based on the 80/20 principle. We don't own 80/20 as a principle, but the way we apply it in terms of the way we operate our businesses is essentially that we focus our entire businesses on outserving the relative handful, the 20% of customers that typically generate 80% more of the profit and growth potential in any industrial business, at least any industrial business that we've come across, certainly. And as a result of that kind of intense focus on a relative handful of large, important customers, we typically generate best-in-class customer-facing execution in terms of cost, delivery, value add, and also we generate typically operating margins and returns on capital in any industry we operate at 2x or better the industry average.
Well, look, I got to congratulate you. You're just doing it right. Others are falling by the wayside. People kept asking me, what is with this ITW? And I kept saying, hey, maybe it's just better managed, which it is. Thank you to Scott Santi, the chairman and CEO of Illinois Toolworks. Well done, sir, and great to have you back.
Thanks, Jim. Good to see you.
Mad Money's back after the break.